Hello, everyone. Thank you so much for joining us again for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy. Thanks for our listeners jumping on the call. Wow, we had a huge rebound in the market from its worst week that we saw in 2024. So we just saw some positive inflation data suggesting that consumer prices are nearing the Federal Reserve's 2% target. So we saw the Nasdaq Composite rise about 6%, the S&P and the Russell both were up about 4%. Every S&P 500 sector was in the positive, except for energy. Now, what led? Surprise, surprise, technology. That was up about 8%. But we did see crude oil prices rise about 1.5% due to some hurricane concerns causing some U.S. Output disruption. We did see also gold futures climbing 3% to a record of 2,600 per ounce. Now, if we look at the CPI that did come out, that initially triggered a sell-off and a rise in those yields. The CPI is a consumer price index. We look at the equity indices, they recovered pretty nicely with the odds of a 50% or a 50 basis point cut by the Fed being baked in a bit. So all in all, I think the market was assuming or now expecting that maybe the Fed could go 50 basis points on its cut here in the next couple of days. Or are they just going to go 25 and the market's trying to always gain that just a little bit? But we did see the Fed announcement changed. They did make an announcement to change some banking regulations, reducing the capital requirements for large banks. Maybe the banks can now increase their dividend, maybe some share buybacks with that. We did see some banking shares fell due to concerns over declining net interest income, maybe some trading revenue in terms of their earnings. We also wrapped up the U.S. with some consumer sentiment that rose to a 4-month high in September. But if we go overseas, we did see the European Central Bank cut interest rates by a 1/4 point, signaling some further reductions. Now, the EU did avoid a recession despite some economic pressures. What is the problem child over there? Germany. They're struggling significantly. Now, if we look at the spoke with the former ECB president, Mario Draghi, he did warn us of long-term sluggish growth without some policy adjustments. We look at the UK, their GDP growth did remain pretty flat, even though we saw some labor market strengthening. China, we saw some CPI numbers rise due to some higher food costs. And if we look at their exports, they increased about 9% year over year. And what's going to happen this week? This week is all about the FMOC, the Federal Reserve. They're coming out Wednesday, and they're going to make a decision. Are they going to lower rates 25 basis points? Because they've already said the next steps are down. It's time to do it. Or are they going to do 50? What is the market going to do with that? We're also going to see some Q3 gross domestic product growth forecast coming out, and I think that's projected to be about 2.5. So we're still looking at some pretty good numbers for the economy. So maybe they don't have to be as aggressive in lowering rates to 50 when 25 might be their first, maybe more logical first step. Now, if we look at the U.S. economy calendar, we'll be looking at retail sales data coming out, some regional banking, manufacturing numbers, some housing data. That's all going to be coming out in the United States. But if we go overseas, we're going to be looking at what are some interest rate changes going on? What are some CPI numbers coming out for England? Then we'll be looking at Japan. What are we seeing in terms of a stance for Japan? Are we looking at rate hikes due to maybe a more hawkish comment? We'll just have to see. Jeremy?
Gotcha, Graham. I had a question for you. So if we just come from a history standpoint, what do you think the Fed's going to do, or what do you think how it'll affect the markets?
Yeah, I mean, if history's any guide, if we looked at the S&P 1 year after the first cuts in rates, and that is no recession, and we're not expecting one. We don't see it. the market averaged 18.5% return. Now, after the first cut 1 year later with a recession, it was still averaging 11. Either direction, it's still positive. One other thing I'll throw in there, it doesn't matter with the election. It's headline risk. It's emotional. The market will probably have some volatility coming into that. I think we've already been seeing that a bit this year. I would not be surprised if that continues. But Republican, Democrat, majority, minority, it doesn't matter. The markets are still positive. And I know later this week, Jeremy, when we get into our lunch and learn, I think we're going to spend a good bit more time on the Fed and the effects on the market, as well as what happens to the markets during the election, right?
Yes, sir. Well, we appreciate the expertise, Graham. Thank you so much. And thank you to everybody, to all our listeners. And if you do, check us out on social media, check us out on our website. We have all of these weekly wrap-ups on there under resources tab. So we'd love for you to go check that out, and we'll see you again next week.
Take care.